Yes, good morning, Jason. Good morning, Chris. Good morning, Stephen. I trust you well. So I believe that we can give it 1 more minute, then Chris can proceed. So we are recording the session, and this session will be shared within the network. So, and we're looking forward to an engaging session. I mean, I will wish to request the participants to actually ask questions to Chris, and so that this can be quite an engaging conversation. So thank you. Chris, good morning, and thank you very much.
Morning.
Yeah.
Happy to be here. Let's give it a few more minutes. Thanks.
Perfect. So Chris, we'll just give you 1 more minute. Then we can start, we can begin, and the recording is being shared.
Okay, no problem.
Perfect.
Morning, Chris. I hope you're good. We're really looking forward to the session. Thanks.
Thank you. I'm doing very fine. Thank you. Thanks for asking.
So yes, Chris, I believe you can begin.
Good morning. Morning, Vivan. Happy to be here. First of all, my apologies. I think we were meant to do this on Tuesday, but I was on a flight coming back and we didn't want to risk that I'd have challenges probably exiting airport and not make it on time. So very happy to be here and happy to have this session. Hoping it's going to be very interactive.
Yep.
Great. So I'm here with my assistant, Jason, and Jason will be helping us out with the slides and a bit more. Jason, do you have the slides on? I can't see. Let me see. Good one. Great. So for those of you who may not know me, my name is Kris Senanu. I spent 25 years in technology, mostly telecommunication. And during that period also, I've always been an active angel investor, a mentor to a lot of startups. And I'm very excited about growing businesses in general. So that's who I am. And these days I spend most of my time helping out on boards and helping out on commercialization or let me specifically talk about B2B commercialization of tech and tech-enabled startups. So that's where I spend a lot of my time. One of my key passions is education. So I also spend quite some time helping out on some education entities. So that's a bit about me. We can go quickly into the meat of why we are here today. let me also tell you a little bit about my company, BlackRock Capital. So BlackRock Capital was started in 2014. No, not 2014, sorry. 2008. We had a company before that called Sensense, which stood for Senanu and Sons. But then that was in the early investing days between 2002 and 2008. We felt we needed something a little bit more focused on the investing. And so BlackRock was created out of the ashes of Sensense, where in the time when we had Sensense, we used to do probably 90 or even 100% investing in businesses. Somewhere between 2007 and 2008, I completed my MBA in Warwick, and I realized that I didn't really like to own businesses fully upfront. I preferred to be just an investor, have a significant minority stake that would ensure that we are influential enough on the board, but then we can sleep at night, if I can put it that way. So the investment approach on BlackRock is really look for industries and companies in spaces that we're passionate about, the places that we know we can add value, both financial and non-financial value. And we've also, as BlackRock, done a lot of structuring of debt because we realized as we did our investment that a lot of SMEs actually needed help in structuring their financing. And it does not necessarily always have to be equity. Sometimes they needed short-term bridge financing in debt. I think the statement for this slide, the key message I'm trying to pass on my first slide is to say, while capital is crucial, non-financial support plays a very significant role in shaping startup trajectory. And simply because for all intents and purposes, startups are startups. Startups need guidance. Startup needs hand-holding to pass those dreaded year 3 and year 5 milestones. So let's take a pause and rewind a little bit. Next slide, Jason. I thought I'd, I think yesterday or 2 days ago, how does a company that raised so many $1 million totally flat out broke? What went wrong? And so on this slide, you have 5 very notable logos of companies that were doing very well. Yes, Google, 3 billion Kenyan shillings plus. So you just wonder, Sky Garden doing so well, marketing all over, bust, luckily bought by Lipa Later, Notify Logistics. I dodged a bullet over there because some of you might know, Notify actually came to the Lions Den. I was one of the 2 Lions who came together to invest it. It was myself and Joan Mwangi. I did a due diligence. I asked my questions. And I just didn't feel right about some of the numbers. I must say in the initial first 2 years, they did very well. They expanded. I used to sit and wonder, did I just miss my big one? Because every angel investor, you invest in 10 and maybe only 1 is going to really, scale up and become that unicorn. And then Kune, who were solving a problem that maybe never existed, raised some good money and became a total sensation on one hand, but also the butt of a lot of jokes. I also decided to put Nakumat in here because sometimes we look at this from a startup stage, but it's really not a startup problem. you have solid companies, great cash flow, opening up branches all over, and then one day bust. So I thought it's very important to remind all of us why value addition is critical, not only on the early stage, but to all businesses. And the real thing, I guess I'm communicating here is that money matters, but money is not everything. If you meet 7 out of 10 startup founders or and ask them, what's the one thing that bugs you, that you don't sleep at night? 70%, 7 out of 10 will tell you, I need more money. I need more money. Only if I had some more money, I'll do A. If I had a little bit more finance, if I had access to finance, A will happen. If I had access to finance, B would not happen. There is an obsession with financing being the panacea to solve all problems. It's a real obsession that we have, specifically, I would say, in Africa, and definitely in Kenya. We think that money will solve it all. And I'm here to say that actually, money is important, but it's not more important, as my kids used to say when they were younger, than other factors. There's actually many factors that are very important. Let's move on, Jason. So, what is more important than money? I have 3 slides for today's presentation. One is about expertise. One is about mitigation of risk. And the third one is about accelerating of growth. Talking about expertise, I have often been known to say, I would rather invest in an okay idea with excellent execution skills than a great idea with poor execution skills. This slide could easily have been named talent. But I talk about aligning of expertise because I've been in several situations where people actually have had the talent, but the expertise in that talent or the skills have not been aligned. And so I would like to posit that irrespective of the amount of money somebody raises, irrespective of the greatness of the idea, if you don't have the right people in the right teams at the right time, and that's how you align expertise. Expertise from your board of advisors or board of directors, expertise from your leadership level, your senior leadership team, and expertise on the workers who are actually going to hit the ground running. That is very critical. And in terms of value addition, one of the things that I've realized is entrepreneurship is a very lonely journey. I spend a lot of my time these days just having lunches, breakfasts, coffee dates with founders and co-founders of businesses. And why? Because I'm yet to find one who has enough support systems that they don't want to have a conversation and bounce an idea of somebody who's been there, done that. And about 6 years ago, I got to the point where I said, well, putting in money in businesses is all well and good. But if I put money in a business and I don't have the time to mentor the entrepreneur or the time to sit down and add some brain power, help them put together focus groups, help to, look at their talent pool and tease out what are the critical skills and talents needed to grow that specific business, then it's a high likelihood that I should not invest in that business, or that if I do invest in that business, then I should not expect the growth, any double-digit growth type of situation. So what I'm saying is that understanding the right skills that are needed at an early startup stage and helping founders and co-founders find this talent, attract it, hire and grow with them is very important. These days, one of the things that I've seen on this area of aligning expertise or skills is a lot of techies are coming up with good ideas. The challenge there is they may not necessarily have the commercialization skills. And so one of the things that we've done as BlackRock in the last year, I've spent a lot of time interviewing potential co-founders for technical people who've set up businesses or have a great idea. Because we found that without having that partnership at the top, without being able to put the technical skill and the commercial skill together, aligning this, the business will go somewhere, but it may not necessarily go far and it may not be sustainable. So actually anybody on this, any female on this call who's interested in being a co-founder, I'm actually looking for 2 female co-founders of one of our investee companies where we need somebody with commercial skills, client-facing skills and marketing, that area. So yeah, that would be what I talk about, the aligning the expertise or the talent, this talent slide. We can go on to the next slide, Jason. I see the questions are coming in. So on the second slide, we're talking about mitigating risks. Most often than not, when there's a great idea on the table, people are only seeing the opportunity, market size. These days, I think Nairobi will become a center of excellence for production of PowerPoint. In fact, in my last corporate stint, I typically make a joke and say, I got a certificate in proficiency in PowerPoint production, which is PPPP. So Nairobi will become fantastic at pitch decks and PowerPoints, and where the big bubble of the market size, and then we show the one of the captive market or addressable market, and then we do some complex Chinese calculations, and then we say, hey, presto, this business has a market opportunity of 17 billion, and we are only going for 10%, 1.7 billion. And then investors start coming in. Most often than not, we don't look on the other side. The opportunity, I think we've become good at sizing opportunity, which is a good thing. Very happy with organizations such as VBAN Network and the other angel investing networks who have been doing a lot in educating people. But I think we also now have to spend some time educating people on how do you mitigate risks? How do you spot them, and how do you mitigate them? The truth of the matter is that sometimes people, founders and co-founders, don't do a great job at market research, or they're blind. They have a myopic view of an industry. They're only looking at a specific area, and they don't look at what I'll call the adjacencies as competition. Some of the work that BlackRock advising has done in the past is to do very clear market analysis, look at competitors not only from a direct competitor point of view, but look at it from a 360 point of view. Who could become a competitor in the future? And so looking, most often than not, we only think about risk mitigation when it's a big company. Somebody will say, if Nakumat had the proper governance in place, they'll have never gone down, and the risk would have been mitigated. That is true to an extent, but when you find people who know what is right and refuse to do what is right, then you have a totally different issue. So under mitigation of risk, a lot of times people get into regulatory and compliance risk issues where they may not have deployed in the right industry standards. I'm very happy to see that we have quite a number of bodies, specifically in the fintech space, who are looking at issues to do with compliance and regulatory. Whether or not the central bank should be dipping in there and telling people what to do, I don't know whether that is positive or that stifles innovation, but it's good, specifically on fintech. The reason why regulation is important, whether it's self-regulation or regulation coming from a central body, is because it's people's money, it's people's savings, and we want to grow successfully. So being able to analyze a particular company's potential risk, being able to analyze company risk specifically, and also company risk and industry segment risk. Most often than not, a lot of people don't look to that extent. And so that's always very critical. Jason, I think your PowerPoint just disappeared. Anyway, let's continue. So risk mitigation, very important. We scan the market, we scan the company's competitors, we scan the industry, we scan the segment, and we look at risk forecast on that particular company. Most often than not, I see at the back page of our posh PPTs, one page on risk mitigation, and it's normally just the generic risks that people talk about. So what I'm talking about over here in value addition investing is doing a thorough job on trying to understand or anticipate what could become a major risk to any particular company. Last slide, Jason. Okay, as Jason gets that up. Are you having challenges, Jason? Okay, well, the last bit of it was acceleration of growth. Can you hear me?
Yes, we can hear you.
I can hear you. I'm just, oh, there, it's appeared.
Okay. So the last is acceleration of growth. So it's all well and good. You know, we started this conversation saying, why do companies die even though they've raised a lot of money? Why do companies stagnate although they've raised a lot of money? And what I'm saying is they die because they don't look at risks. They die because they don't have the right thinking capacity around the table on the right levels, strategic thinking at the board level, operational excellence in terms of executing skills at the management level, and the people who are passionate and ready to move the business to the next level on the ground floor. And the third factor in terms of value addition is helping to accelerate growth. Several companies die or stagnate because they don't grow as fast as they should. There's certain businesses, when you start, you need a real boost in the beginning. And most of these boosts come from really leveraging networks, leveraging partnerships, connecting the dots with adjacent industries where you can co-brand, co-package things together. So again, helping to identify opportunities and refining GTM strategies. A lot of companies will do the same old, start up a business, hire a team to sell and go to market. These days, there's a couple of companies that forget about even outsourcing your sales force to them. They actually, what they're doing is they just focused on selling multiple company or multiple products. So they have sales teams. They can give you B2B sales. They can give you B2C sales. They can hire, train, and actually handhold to market early stage companies, because sometimes as early stage companies, we don't have the necessary skills across the board. We may have very good technical skills, develop DevOps skills, but we may not have the commercial skills. The question becomes, if you don't have the commercial skills, is it always the best strategy to acquire, or can you partner with somebody who has these commercial skills, who's willing to push your product at a revenue share, or push your product at a flat rate? If you pay them to run the whole sales team, or to be in charge with the commercialization. So acceleration of growth is also a very critical space where value addition comes in. And to be very frank and honest, I've now begun to meet entrepreneurs who are saying, okay, apart from the money, what else are you bringing? And I love that there's now pushback, because a lot of people have money, but money alone will not build a great sustainable company. Last slide, Jason. So BlackRock Capital and BlackRock Advisory, what we do, these are 6 areas that we operate in. Business strategy is one of the areas that we do a lot in. Brand strategy, financial restructuring, be it debt or equity, getting companies investment ready, management coaching for mostly the C-suite, CEO, COO, CTO level, and sometimes a bit of digital transformation, where we're trying to see and help companies automate and or use the best technology available for their industry. Let me touch a little bit on investment readiness, because this is an important one. A lot of companies start raising funds when they're not ready for investment. And one of the things that I've been spending time on in the last year is investigating this fallacy that if you are white skin, you can raise funds faster than if you're black skin. And I can tell you so far from the 36 companies that I've talked to, one thing that is becoming very clear is that a lot of companies fail to be able to raise because they're not really investment ready. So investment readiness has become a space where a lot of help is needed. And we've been doing a little bit of advisory, a lot of advisory work in that, in business strategy and investment readiness. Great. Last slide, Jason. I thought it's important to show a little bit of BlackRock's portfolio. On the left, a lot of tech and tech-enabled companies. On the right are other companies. This is just a sample. I have one of my favorite companies right in the middle, Mama Shanti. I tell people that business is not necessarily, it wasn't built for making money. It was built from a selfish need of wanting to eat my own West African food in East Africa, and happy to note that next month we'll be celebrating our 8th birthday. So definitely past the year 3, year 5 milestones and moving on. Next slide. And that's basically it for now. So I think you can take off the PowerPoint slide and let me look at the questions that we have so far. Or rather, let's open it up because there might be follow-on questions that people have. So yes, ladies and gentlemen, those are the areas of value addition that investors can bring on board over and above money. And just like we started with the slide where you had many startups that have raised cash but have still bitten the dust, I think it's something that we should all be conscious of when we go investing, that over and above money, what else can we do? How can we add more value? Thank you. Open up to questions.
Okay, Kris, I'll go first. So just to ask the question on the charts, what then is your advice for angels who are doing angel investing as a side hustle? They want to treat it as a financial investment because they do not have time for the required coffees and lunches.
Okay, that's a great question.
Yeah.
There is always time. Let me start from that. If there's one thing I've learned, the busier I have gotten, the more time I have found. And it's simple, because if something means a lot to you, you will find the time. A coffee date, I tell people a day is 24 hours. Myself, when I was hectic in corporate, I used to split my day into 3, 8 hours for the corporate, 8 to 10, another 8 hours for myself, and 8 hours for sleep. Now, unfortunately or fortunately, some of us are blessed. If I sleep 4 hours, I'm tired of sleeping. So I have 20 hours when the day starts, when most people might have 16. But if you are serious about it, you'll find time. Most people, angel investors, might be invested in 3, maybe 5 investments. Genuinely, in a 30-day month, that is taking 1 evening a week to sit with an entrepreneur to engage. And if you really want to treat the angel investment as a financial, as part of your portfolio, then it should be possible to find 1 evening. Sorry to be blunt, but when people tell me they're busy, I know busy, I've been busy, but I found time. And I think each one of us can find 1 evening. You just lock it down. I used to do 3 slots per week for entrepreneurs. Saturday morning, 11 o'clock, Thursday evening, 5 o'clock, and sometimes Tuesday, Thursday, and Saturday, 3 slots, 90 minutes each, consistently for 11 years. So if you are serious about it, you will find the time for it.
All right. Okay, Kris. So I think that's just a matter of time management. Yeah. So you mentioned something about female co-founders. So probably for the interest of those who may be interested in this, and also for those who will access the recording afterwards, what were some of the requirements that you're looking for?
So 3 things. 1, somebody who really maybe would like to be in the startup space. They may not necessarily have an idea, but they're ready to get in and prove their value. Mostly on the commercial side. We've got a lot of guys who have great ideas, but they need partners who are commercially inclined. So somebody who's done maybe 3 to 5 years in corporate, been in either sales, marketing, PR and communication, understands how to push products or services into the market, and is willing to become a co-founder, get shares, help to build a company, and get shares. So as opposed to an employee, you're being brought in at the top level to be a co-founder and to gain as the company also grows.
Okay, perfect. So this could actually be more of a full-time.
Oh yes, these are full-time. Yeah, these are full-time. These are entrepreneurs looking for full-time partners. So of course you get paid a salary also, but the reason you're going there is not because of the salary, it's because you want to be part of the initial team and the success of the business.
Good. Oh, thanks for that. So another question on the chat is that you mentioned accelerating growth. So what's your view on the Silicon Valley model versus the step-by-step approach. I mean, one could argue the likes of Kris, Sandy were going for this model. So that's a question from Stephen Gugu.
Yeah, and Kris, maybe just to create a bit of context on the question, you mentioned that there's business which need this, push on growth at the initial stage, and of course, they raise a lot of money, and the whole idea is, acquire the market as fast as you can, and then fix things later as you move on. Now, of course, some of the challenge that brings up is what we've seen with the likes of Sandy, and there's others which are in the deathbed also, which will be coming out in the next couple of months. But then how do you balance that aspect? Because indeed, you do need businesses that go with that model, and they need that lead time for them to be able to get to a point where they're profitable. But then our markets are not supporting that. And I guess to a certain extent, if you don't go that direction, there's also the view that you become too small to a certain extent, or you don't expand to the level that you should have expanded to. So I'm just curious just to hear your thoughts on that topic, because I think it's one that is going to come under sharp focus in the next couple of months.
Stephen, thank you for that question. I am yet to, hindsight is 2020. I'm yet to meet an entrepreneur whose business went bust and has said, and who was going for the fast growth model and the business went bust and they haven't regretted. These days, I tell a lot of entrepreneurs, the market will teach you some very solid lessons. It's all well and good to sit drinking your own Kool-Aid, thinking you have the best product and pushing it to the market. But at some point in time, people dictate by putting their hands in the pocket and paying for your service, or they won't pay for your service if the service isn't good. So let's double click on growth. When the reason for accelerating growth is typically in the first instant, you're trying to reach break even. Because most businesses fail to get to break even. But if you look at it carefully, what is break even? Break even is you have a certain level of fixed and variable cost that you need to overcome, where you don't make a net profit, but at least you don't have a loss. But sometimes people fail, in the case of, for example, Sandy, they fail to look at the costs. Do we really need to layer on all these costs at the beginning? So when you accelerate growth because you've put a high cost for no good reason, then the real question that you need to be looking at is my cost structure right? So we have to shift from let's grow fast, let's grow fast. Actually, some level of accelerating growth is just organic.
Yeah.
But the challenge is that people have gotten, like I was saying, this proficiency in PowerPoint presentation and PowerPoint production has made us say, no, let's raise. Raise for what? When your core product is not well done. The challenge is the number of startups we are seeing failing are just 1/3 of the ones that are failing. I know of a startup who raised $3 million on the 21st of October, 2021, bust. Why? Because they put an OPEX, they were having a burn ratio of 40-50 million shillings a month, whereas the core product, the product wasn't there, but they had a whole commercial team, 7 people, costing almost like 6 million already in the company when there was no product to sell. So when we are trying to run for break even, when we're trying to accelerate growth for break even, can we also look at the costs that are actually there? To your question, which is better, a fast versus a slow, it really depends on the sector. I tell people, go to market with a minimum viable product, spend some good time tweaking it. When you get full product market fit, when customers are nodding, then accelerate the growth. But why are you accelerating the growth of a product or a service which people are like 50-50 in the market. And sometimes as entrepreneurs, we fail to ask the basic question. I always ask when I go to test the products for investee companies, I ask friends, family, and anybody I can meet, would you pay for this? Because, you know, one of the things that we are very good at in Africa is, oh, it's my cousin, let's go and support them. Let's go and support them. I say, rubbish. Don't support a business that's not going anywhere. Actually, the best support you can give to such an entrepreneur is tell them, by the way, this service of yours or this product of yours is crap. You know, it's total crap. And if you don't do A, B, C, D, then when you start going for the real customers, you will realize that they are not willing to pay what you are asking for. Sometimes that's the best thing we can do to support our friends and our family who go into business. Tell them the truth about their product or their service. Tell them that I'm paying because you're my cousin. If you are not my cousin, I would not pay for this. I wouldn't touch this product. We need to be frank, because a lot of people are in a situation where they think they have a good product. They've been lied to by their friends, families, and fans. And then the market teaches them a lesson and a half. I don't know, Stephen, whether that answers.
No, it does. I think one point that you make that is really relevant is this idea of not accelerating growth to meet an unsustainable cost model, you know, because at times people are going for that and they don't realize that at some point you still have to deal with the costs eventually. Thanks.
All right. So thank you, Kris. Thank you, Stephen. So we have another question from Joe. So Kris, what do you look for as key indicators that a business is investor ready, and what will this differ based on the kind of investor being targeted? Is it angels or VCs?
Investment ready is a business that has proven its business model. You have your unit economics down to the T, and you can tell somebody right now, if you put 1 million shillings in my business, in 3 months, it will produce 1.5 million, because this 1 million is going to buy X amount of input, will pay for Y amount of salaries. And from where I am today, this is going to be the impact. And you can clearly show that X invested will have this impact on the company. A lot of people don't have their unit economics down to a T, and they may not be able to clearly articulate what value a particular investment would make. And when you don't have that, then there's also confusion about what type of money to get. I'm one who's gone in for meetings. Somebody said, oh, I need an investment. And I go and I look, I say, well, yeah, you do need some money, but the money you need is not equity at this point. What you need is debt, because there's also, sometimes entrepreneurs are at the stage where they don't need a partner. They don't need an equity partner. They need some debt and they need some space to figure out a couple of things for themselves. And to reach a certain stage before they bring in. We now have a lot of arguments going on in Nairobi, where again, because of the 5 Ps, the proficiency in PowerPoint, people are pitching and saying, oh, no, my business is worth $7 million. And then when you ask, how is that valuation? How do you arrive at that valuation? They want to put $6.7 million on goodwill and the thought, and then the balance $300,000 on tangibles. Now, an investment-ready business is a business that you can clearly see that if you put X amount, it will produce Y. And so the valuation is Z based on the unit economics and a very clear path to profitability. We are in investment winter now. There's a lot of money, but nobody is willing to write out checks.
Yeah.
And so people are going to have to prove beyond the PowerPoints and beyond the crazy valuation skills or methodologies that the business is. If you put in money, there's going to be an impact, there's going to be a result. Also, I think, let me call it founder and co-founder mentality, readiness. So a lot of times people want money, but they're not ready to get an equity partner or an extra shareholder who comes and helps to influence and direct the business. I think there is a point where entrepreneurs feel that this is mine, 100% mine, and I want to be left alone to do my stuff. And then there's at a point where there's like, okay, I need a partner, I need some help. And they are ready to put up their hand and say, okay, yes, ready to accept help. At that point, my advice is then understand yourself as an entrepreneur and understand who would be a suitable investor in your business. There's some investors where they put money and they chase their money. They want to be there every weekend asking you questions. And there's others who are willing to put their money, give you the space to do what you want. Some people need the guidance and need an investor who's there, prominent and let me call it prominent and pensionable. And then there's those who want an investor who puts in money and keeps quiet in the corner and they produce results. So it really depends on the type of entrepreneur you are. Thank you.
All right. So thank you, Kris. Just to tie that up on that aspect of valuation. I mean, I get a lot of requests, and what I see in some of these requests is an amount on marketing. How much cap? What is the limit of the marketing budget that a startup should actually be presenting, or a business? Because we all know that marketing and advertising does not really lead to actual conversion. So is there a cap that startups should actually put on their marketing budget when they're requesting for funds? And what typically is the range that investors will give for the marketing budget?
So that's a bit of a trick question for me. I tell people I've spent most of my time in technology, but I'm actually a chartered marketer. And when you say marketing doesn't push products, there's marketers who will kill you for making a statement like that. But yes, there's a reason why I've never been keen on pursuing a marketing career. It's because I always said marketing is pink and fluffy, and I prefer to be on the other side where the numbers are. Now, I would typically not agree to sign off a marketing component of an investment, which is more than 15 or 20% of the total investment. So I'd say the total maximum cap would be 20. So if you're raising $1 million, specifically at the startup stage, where it's really, really new, greenfield, I wouldn't expect more than 20%. Having said that, so you have to take 3 stages: startup stage, growth stage, and mature stage. At the growth stage, that percentage could go up to 30 or 40% of the investment needed.
Okay.
The startup stage, much lower, because what are you marketing? And this particular company that blew $3 million in 18 months on nothing, that's exactly what they did. Spent a lot of money on marketing a product which was not ready for market. I mean, ready for the clients. So if it's the early stage, 15 to 20%, if it's the growth stage, 40, 50%. And when it becomes mature, you lower it again down towards 10, 15% of total OPEX.
Perfect. So if you can take probably 1 or 2 more questions, because I see that we have 3 minutes into time, I would be more than happy to, from the audience.
Yes, definitely. Not a problem at all.
Okay.
The audience is on Friday break.
All right. Okay, so Kris, I want to extend my sincere gratitude for the acceptance on this session. Yeah, and also want to say thank you a lot for making time for this, given that we had that travel agenda. So yes, I'll be sure to forward the recording later, and all I can say for now is have a happy weekend and a great one, and also congratulations on Mama Shanti on celebrating your eighth birthday, the 8th birthday next month. Yes. So this is a pretty happy birthday.
Well, thank you very much for inviting me and giving me an opportunity to share some of the nuggets of little, I wouldn't call it wisdom, the little stuff that we know. A lot of this, Jason is my assistant, and anybody need help in the area of business consulting strategy can always reach out to us. We have a team of 6 people, and always happy to help. Happy to do some freemium, always in the beginning, to understand and analyze. And let's build this entrepreneurial ecosystem together. Asante sana.
You're welcome, Kris. Thank you very much.